So in the textbook, Damodaran professor made a great point using this regression about grocery stores. Okay, he finds, oh, there is a positive association confirmed between the net margin of the company and price to sales ratio. Okay, positive, stronger margin, higher price evaluated in the market. And then most of the stocks are within this one standard error band. Okay, hold region. 얼음, don't move. 나 이 게임 해봤어요. don't move. Okay, in Squid Game thing. Okay, don't move. Buy, sell, and whole food. Okay, is in the sell region. Its margin is big, so it deserves high price, but not too much of that degree. Why are you in so high place? You have to come down. Okay, sell it. Guess what happened? Okay, guess what happened? It went down to here in the next year. Okay, so a key idea, okay, again, is that this is efficiency region. Okay, efficiently priced. Okay, market is efficient, the average is efficient, the error bound, okay, one standard error bound or whatever standard error bound, these are reasonably efficiently priced. Hold, don't do anything. But the investment opportunities are either on this side or the other side. Okay, buy, sell. Okay, but the chance is very thin because majority of them are efficiently priced. Value investing opportunity, good luck. Okay, Warren Buffett kind of idea, great, only if you can find some of them over there. Majority of them will not be there. Okay, and then over time it converges to the efficiency bound over here. Okay, and then price to book ratio is also used. Okay, PBV, and the price to book ratio is the ratio of the market value of equity to the book value of equity, and then the market value of equity divided by book value of equity. How do you do that? The consistency has to be there, by the way. Okay, if the market value of equity refers to the market value of equity common stock outstanding, the book value of common equity should be used in the denominator. If there is more than one class of common stock, like class A share, class B share, then the market values of all classes need to be factored in. But I think, this is textbook authors' strictest sense of, pure strictest sense going in. But for our baby step approach in the intermediate corporate finance level, just use the variable name SEQ, shareholders equity, in a CompuStat. Okay, book value of equity, that's it. Okay, that's just good enough. And then the market cap, well, number of shares outstanding times the price per share. Okay, that's just good enough as a baby step. Okay, and then definition of this variable PB ratio is shown over here. And the thing is, bigger font is shown in the next slide, so I will talk about this. PB ratio, price per share divided by book value per share, beginning balance, by the way, and then number of shares outstanding, they cancel each other out, and what is left is the market cap divided by book value of equity as a whole. And the market cap is nothing but the dividend that you expect in the future, discounted at cost of equity minus G. Okay, and then dividend should be nothing but net income times payout ratio, and then if you look at the net income divided by the book value of equity, that's nothing but ROE, and the payout ratio, and then R minus G is the denominator of the numerator, which has to be the denominator in the total number. Now, what's the idea? Price to book ratio is positively correlated with ROE. Okay, PE ratio, we did not have ROE. We only had this payout ratio in R minus G. But now in PB ratio, we have ROE, and then payout ratio is positively correlated with PB. Growth rate of net income growth is positively correlated with the PB ratio. Okay, no wonder price is about the future expectation about the future. So these fundamental growth expectation matters. Those should be priced. Okay, and then positively correlated with the differential between the ROE and the required rate of return, or in this project. What do you mean by this? We just peek the slide before, and you will realize that by relating growth to ROE, the relation between growth, payout ratio, and ROE, we replace the ROE. Replace the the payout ratio. You will realize that the numerator becomes, the whole thing becomes ROE minus G. Okay, so the differential between the ROE and growth rate, okay, affects the PB ratio. And again, PB ratio is negatively correlated with risk. No wonder. Dangerous company, why buy it? We are risk averse. The intuition of economics holds true over here, right? Dangerous company, no. Ideally, we want to work with the expected ROE in the future. And then expected growth, expected payout ratio, expected thing, whatever expected. Why? The thing is, the key idea is our expectation, rational expectation, gets priced efficiently. Efficient market hypothesis. It's all about, the price is all about the expectation about the future. Key point that I have to ask you in your final exam, okay? The margin or whatever fundamental variables, your future expected key variables should be on your horizontal axis, okay? You can use past variable values here if there's nothing else, okay? But that should be based on a strong assumption that your past and the future expectation will be the same, okay? The key idea that you hold on to is that your price or the multiple, okay? The numerator is a price always, right? The price is reflecting the expectation about the future, okay? And they are efficiently priced on average, okay? Whatever deviates from those efficiency range, you have an investment opportunity, okay? That's the idea. And then fundamental drivers, I told you about it. And then now, given that we have ROE, why don't we review for our final exam? Oh, DuPont analysis, right? So decompose it, ROE, and then we realize it's nothing but net margin, asset turnover, 1 plus leverage ratio, okay? And then that tells us that PB ratio is positively correlated with your margin and asset turnover and leverage, payout ratio and growth, all of them positively. But it is negatively associated with your risk, okay? But at the same time, you look at each variable, there is a tension, okay? Clearly you find leverage, okay, is deeply rooted into, deeply affects your discount rate. Hamada equation, do you remember? Hamada equation is based on market value leverage, whereas this one is book value leverage. Moreover, this is not just interest-bearing debt, but also whole liabilities here. But 대세의 지장 없어요. It says the key idea still holds. More financial risk, nothing good. It increases your systematic risk, the beta. So leverage ratio, superficially, it seems like it has to be positively related to your PB ratio, But in the data, we don't see that. We don't find that. Instead, if we throw it into our data analysis, we find negative correlation between the leverage ratio and the PB ratio because of discount rate channel. Okay, leverage affects the discount rate much more before affecting PB ratio. So high risk, low price. We are risk averse. So that is one careful thing we have to do. Okay. The next. Okay, let's go. I would like to throw out an interesting case using K-pop entertainment stocks. You like K-pop, I like K-pop, I like Psy. 2015 I prepared this slide, okay? And then at that time Psy was big in YG Entertainment, so I wanted to see if YG was correctly priced or undervalued or overvalued. So I just came up with the industry competitors, JYP, SM, and a whole bunch of them with the PB ratio, and I obtained the median 2.87, YG 4.08. Immediately I could tell a little bit, oh, maybe it's overvalued. Should I sell? Is a fair question that I have to ask, okay? But we know the analytical relation between PB ratio and the economic fundamentals like ROE, payout ratio, growth potential, and risk. So let's dive into that, okay? So I first worked with the expected ROE, okay, of each different companies. Expected ROE, what do you mean? Well, luckily, I had the data about analysts' expectation about all these companies' ROEs going into the future. Okay, not all stocks are covered by analysts. I told you, out of 2,600 stocks in Korea, about 800 to 900 companies are covered by the analyst. About this ROE coverage, by the way. Okay, so it reduces. I told you before. Okay, the sample. But with that limitation, I just threw it into a regression framework, and I weekly confirmed positive association between the ROE and the PB ratio. Okay, you see a positive slope. Okay, but the result was not that strong enough because the T statistic was too low, p-value was too big. Okay, but just weakly confirmed, and I came up with the standard error so that I could draw a bound. Okay, with the caveat. Okay, it's just weak result, but I could roughly see some stocks are undervalued, some stocks seem to be overvalued, and YG was just in the band. Okay, I don't know. If I had to find out anything is really undervalued, maybe these two stocks, which is like Hello Vision and what is it? The CJENM. So I was like, should I buy it? YG is 4.08, something there, and some stocks seem to be overvalued, low end. Okay, then to make sure we need some more confirming evidence to support our conclusion about buy, hold, sell. Notice even though our slope coefficient was positive, it was not statistically significant. So we may want to resort to other multiples and see if we find common conclusion pointing to the same direction. Oh, sell, oh, sell, oh, sell. Okay? So relative valuation or whatever valuation, make sure you find try to find the consistent results regardless of the measure that you use. Okay? Now, reality check after the fact. Okay, 1 week after this analysis, the price of CJENM increased by 16%, while over the same period, the other entertainment stocks rose by 5%. So 11% abnormal return was there. So maybe I was, correct in using that, regression analysis, but that was a weak result. Okay, there's a caveat. Okay. Anyway, I focus on YG Entertainment, by the way. Problems with the regression methodology Well, the basic regression assumes a linear relationship between this PE ratio and then the financial proxies, and that might not be the appropriate, might not be appropriate. Did I use PE or PB? PB ratio, okay. Maybe I should, I'm sorry about this misprinting, a typo, PB, okay, but it does not matter. All in all, regression assumes linear, straight line, okay, not like curvy relation like this, or any transcendental 초월함수 thing. No, sine, cosine, no way. It's just a straight line, okay, just a straight line assumed, okay. There is a limitation. What if it is not? Number two, the basic relationship between PB ratio and the financial variables itself might not be stable, okay? And if it shifts from year to year, the relationship shifts year to year in the data, the predictions from the model may not be reliable that much. A lot of noise in a sense, okay? Number three, the independent variables are correlated with each other. I told you before, right? Those leverage, for example, it's related to beta discount rate. So there will be a lot of trouble, okay? Multicollinearities can bother you if you throw in all these variables simultaneously, okay? Beware, right? For example, high growth firms tend to have high risk. This multicollinearity makes the coefficients of the regressions unreliable and may explain the large changes in these coefficients from period to period. As you do this kind of application, number 4 step, right? You will realize, most of the time we don't find confirming results because of this reason, okay? So that's a caveat you have to think about. Now, PB ratio, we are not satisfied. We can use other multiples. Another candidate is EV to sales ratio. What is that? Well, market value of asset over sales, okay? For each dollar of sales, how much is it evaluated in the market? Okay, that's the idea of this multiple. But there is a variation about it. Would you use enterprise value as your numerator or the market value of asset as a numerator over here, okay? So the denominator is the same in the sense that it is the sales number or revenues. That's the same thing, okay? Same vocabulary. The numerators are different, okay? Slightly different as much as cash is concerned, okay? Here, using enterprise value is just to be hardcore pure about getting the market value of your operating asset. Operating asset, well, free cash flow to firm, okay? Your day-to-day business, 본업에서, your core business, how much cash do you generate, and then how much is it evaluated in the market, your core business. That's enterprise value concept. Market value of asset, well, just relax. If there's a cash amount, just don't delete it, okay? And then market value of asset, how much is it, okay? Per each dollar of sales that you generate, okay? This kind of sales-based multiple is useful if you are valuing retail industry where the sales matters a lot to the general customers, the general public, and then the consumer goods like cosmetics, your Estee Lauder kind of companies, right? So EV to sales or value to sales kind of things will be important. Also, if you look at the distribution of EV to sales of Korean firms using Windsorization, it looks like this. Again, right skewed, and then analytically, okay, how is it decomposed? So start with the definition EV to sales and don't touch the denominator because there's nothing more to do. It's just fundamental number that you are interested in. what you can manipulate analytically, mathematically, is the numerator. In this case, EV, okay? Why don't you do it with the market value of asset, including cash? Well, minus cash, that small thing just bothers too much. So just relax, get some life, work with enterprise value, okay? And then realize enterprise value is nothing but the present value of FCFF. And FCFF, recent fiscal year past, and then assume some slow growth rate, one stage growth model. It should be WACC minus G on the denominator. Okay, that's what's going on over here. And then FCFF over sales, and then 1 plus G over WACC minus G will be the other factor. And then how would you analyze further? FCFF is nothing but NOPAT, net operating profit after tax, right? EBIT times 1 minus tax rate times 1 minus reinvestment rate. You remember that formula for the FCFF? We use it over here. And then the denominator sales keeps on being here. The other factor sustains. And then we go one more step. Because EBIT 1 minus tax rate divided by sales is none other than after tax operating margin. This is about the profit margin, okay, the first item, times 1 minus reinvestment rate times the last factor, okay? Now, what intuition can we extract out of this relation? EV to sales is positively associated with after-tax operating margin, and then positively associated with growth rate, and negatively associated with reinvestment rate, and negatively associated with risk, okay? Makes sense, right? Commonly with PB ratio or PE ratio all across, as long as the price multiple is concerned, right? Your market price is positively correlated with growth prospect, positively correlated with your profit margin, and negatively correlated with your risk because you are risk averse, okay? That's the basic intuition you get out of it, okay? The next is what should be the EV to sales ratio of Amore Pacific if we have the following information. Analytical fundamental variables. If we have this number, we can calculate the fair EV to sales ratio, okay? So after tax operating margin, let's assume it to be 30%. Reinvestment rate, let's assume it to be 80%. Growth rate of EBIT, assume it to be 6%. WACC, 9%. And then your EV to sales ratio has to be the multiplication of 30% times 1 minus 80% times the factor 1 plus G over WACC minus G. Growth rate of, it has to be 7%, 6%. I'm sorry about that number, sorry about that typo. So I will make a correction and then do the rest of the presentation in the next video. So wait for that. Thank you for paying attention to this video. Thank you.